All right, grab your coffee, grab your margarita, however you're trying to get through your day. Let's dive through our content. We've got temporary and permanent differences. Now, these are differences between book and tax income. If I make $10, there will be differences in how we recognize income, but generally speaking, I make $10, I could recognize it for book and tax income. However, certain expenses, certain ways I make income, that might not be the same for book and tax purposes. For temporary differences, these are discrepancies that will eventually reverse over time. So generally speaking, and we'll talk about this more in detail, we've got accrual basis versus cash basis income. Under accrual basis, under GAAP, under FASB, under book income, all those being synonyms and kind of referring to the same thing, I can only recognize revenue when it's earned, whereas for the cash basis, tax basis, IRS basis, I'm going to recognize revenue when I receive the cash. Now, over the course of a year or two, that'll likely be resolved, right? That's a temporary difference because maybe I don't receive the cash until next year, but I complete the service this year, whatever it may be. Those will resolve itself. So that's a temporary difference. And the income from that $10 will be the same regardless. However, we've got permanent differences as well. A great one is penalties. Penalties and fines. The IRS does not want to reward you by allowing you to deduct penalties and fines from your income, thus reducing your tax bill. So for tax purposes, you will never get to acknowledge your penalties and fines as an expense and reduce your income. But for book purposes, you will, just because book purposes, that's just what happened, right? It doesn't, you're trying to reflect what actually happened during the year. That is a permanent difference, and as such, the net income for book and tax purposes will never reconcile because of that. I mean, generally speaking, especially big companies, these will never reconcile, even with the temporary differences. In theory, there's always new temporary differences arising, so as such, that's just going to be the case. Temporary differences can either be taxable or deductible. We'll dive through many examples. There's going to be ones you need to know specifically. We'll make sure you know those as well. Permanent differences never are going to reverse. We'll talk about the concept of deferred tax assets and liabilities. Permanent differences do not give rise to any deferred anything because, well, it's set in stone. It's a difference. From now on until forever, there will be a permanent difference. All right, temporary differences. Let's dive into what those are. Well, for depreciation, and your knowledge of this may depend on how much you remember from school, how much you've worked in the real world. Also, if you took the financial exam before this or you're taking that after. However, either way, make sure you cover everything. Make sure you know it. For book purposes, you're generally going to use the straight line method. I mean, there's other methods, double declining, but let's just say straight line. That's what the exam here is going to generally suggest or mention. So straight line method, which you have a $10,000 asset, 10 years of depreciation. That's $1,000 of depreciation per year. Pretty straightforward, straight line. However, for tax purposes, we use the maker system. And that's in the cost recovery lesson. If you're going in order, that's a lesson you would have seen before. I do recommend going in order, but hey, to each their own. That is a whole different method, arbitrarily made up. Well, not too arbitrarily. I do like to use that word a lot and say that the IRS is just doing whatever they want, arbitrarily making up whatever they want. So those makers tables are going to be very different. Now, at the end of the day, you are going to have this reconcile. If the basis of an asset is $10,000, it doesn't matter if you straight line it over 10 years, bonus depreciation it in 1 year. At the end of its life, it's going to end up being the same. So that's why it's a temporary difference. It's about timing. It's all about timing. That's why it's a temporary difference. This temporary difference results from this differentiation in depreciation expense recognition. And again, that will reverse over the life of the asset. Recognized revenue, kind of alluded to this before. Accrual basis accounting, this should be bread and butter, but if not, make sure you memorize. Revenue is recognized when earned, and expenses are recorded when incurred. For tax purposes, for cash basis, revenue is recognized when received, and expenses are recorded when paid. So when the cash comes in or goes out, that's when you recognize it for tax purposes. For book purposes, it's when it's earned or when expenses are you actually account for them. When you actually get through a year worth of insurance, that's recognizing the insurance expense as that happens. Now, due to these differences, these kind of go hand in hand. These are generally going to always differ from book to tax. In theory, if you do a service in a year and receive the cash in a year, there won't be a difference. This is what I have in parentheses here, but we're not really going to assume this for the exam. We're generally going to assume that there will be differences because, especially larger companies, most companies you're going to have, it has to be a larger company if you're using book income. Accrual basis accounting, you're not really going to do that if you're a smaller company. So if you make a sale in this year and you can't recognize it till next year because you don't do the service till next year, that's going to result in a difference in recognizing revenue and then expenses as well. All right, we got examples. We love examples here because I could talk about words all day, but that might not give you an illustration of what you need to know. Here is a temporary difference between book and tax income. We'll go through some other examples as well. We've got company ABC. What a common name. Gotta love it. Acquires an asset with a cost of $100,000. It's got a useful life of 5 years and no salvage value. We've got the temporary difference illustrated below, and we'll talk about also recognize revenue and expenses on the next slide. So for book purposes, we've got the straight line method. And a question could just simply ask, what's the difference in book to tax? We'll talk about deferred tax assets and liabilities. You might be asking, like, what's the point of this? Why do I need to know this? Also, these differences, again, like I said, do get reported on your tax return if you're a large enough company, and we'll see those actual tax forms in a bit. So here we've got depreciation expense of $20,000 per year for book purposes, $100,000. There's no salvage value. Otherwise, we would subtract that here. Divided by 5 years, that's $20,000 per year. Now for makers, this is, again, if you want to revisit how to do all this, go visit the cost recovery lesson. Assume that the maker's depreciation for the asset is as follows. This is just an example, so don't take this as how it actually works. But makers, let's say it's you do 30,000, then 25,000, then 20, then 15, then 10. You're going to look at those tables. Very complicated process. Not going to go over that here, but just for purposes here, this is what's going on. So the temporary differences in year one, well, you see every year for book, we're doing 20,000. So that's where we get the 20,000, boom, boom, boom. So year one, 30,000 minus 20,000, 25,000 minus 20. So you see $5,000 difference in year two. We keep having these differences in year three. You don't have a difference, but at the end of it, it all comes out to 100,000. This is going to equal 100,000 at the end of all of it. And at the end of all of it, for book purposes, 100,000 will be your total expense. So at the end of the day, well, not at the end of the day, at the end of many days, at the end of 5 years, this is going to reconcile itself out, and as such, it's obviously temporary. All right, now we're dealing with recognized revenue and expenses. Now we've got the same company, ABC. They perform a service in December of year one, but they don't receive the payment until January of year two. We're dealing with calendar year ends here, so for book purposes, revenue is recognized when you complete the service, when you perform your end of the bargain. So that's you perform the service at the end of year one. So for accrual basis, we're going to recognize $15,000 in year one. However, for cash basis tax purposes, we're not going to recognize this until year two. So a temporary difference will be $15,000 in year one. But at the end of year two, this is all going to reconcile, right? Well, I guess at the end of January, but just say in theory at the end of year two, it'll all be good to go. Next up here, recognizing expenses. Assume company ABC incurs an expense of $5,000 in year one, but actually pays it in January of year two. So let's say you are paying for a cleaning service to clean your office. You pay $5,000 in December. You don't actually pay it, sorry. You incur it. So they perform, let's say this company performs a cleaning service of $5,000 in December, but you don't actually pay their bill until January of year two. So for book purposes, you're going to recognize the expense in year one. But for cash purposes, for tax purposes, we're going to recognize it in year two. As such, year one will have a temporary difference of $5,000. Now, again, at the end of the day, I keep saying that, but at the end of many days, at the end of the years, this will all reconcile out at the end. That's the whole point of temporary differences. They'll eventually reverse over time and affecting the company's deferred tax assets or liabilities. I have a bunch of slides on this. I cover this in the financial exam as well. I'm just going to, if you're like wondering, hey, he keeps mentioning these. Essentially, if you, and I'll say this slow, not for you, for me, this can be very tricky sometimes. Deferred tax assets, that means you're essentially overpaying tax now, so you won't have to pay it later. Or deferred tax liabilities, if you have more expenses now for tax purposes and you don't have to pay as much tax now, you'll have to pay the tax later. And I'll go into that much more in depth. We've got better graphics, but that's the gist of what's going on there. Temporary differences will create temporary deferred tax assets or liabilities. That's the purpose of this, and recognizing the deferred tax assets and liabilities will be important. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because Who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.